Hey everybody, welcome to Mortgage Today for Wednesday, March 20th, 2024. It is Fed Day, and oh, what a day it was. UMBS opened down 3 basis points in the morning. Equity futures fluctuated after the S&P 500 hit another all-time high yesterday. New home purchases applications rose 15.7% year over year. Hopefully that'll help their sentiment a little bit, and they'll build more homes. The average loan size increased to its highest level since March of 2023 at almost 406,000, but it is still below the record high from MBA survey of more than 436,000 in April of 22. The FHA share of purchase applications, which provides the read on the first-time homebuyer activity, increased to 25.7%, indicating first-time homebuyers continue to turn to new homes despite the lack Due to the lack of affordable existing home options. The estimated sales pace of new home sales was 689,000, slight decline from the previous month. Fannie Mae has bumped up its end-of-year mortgage rate forecast from 5.9 to 6.4. The housing market is likely to continue to face a dual affordability constraints of high home prices and elevated interest rates in 2024, according to Doug Duncan. Hotter than expected inflation data and strong payroll numbers are likely to apply more upward pressure on mortgage rates this year. Despite the strength of the economy, we are seeing problems with consumers. Auto loan delinquencies hit a decade high in 2023. The pandemic created issues here when car prices skyrocketed due to supply chain constraints, which has set the stage for delinquencies later. Then we got some Fed notes. So the dot plot came in from the FOMC rate projection shows the median official expects 3 quarter-point cuts in 2024, similar to a previous round of quarterly forecasts in December. However, median forecast for 2025 rises from 3.9% to 3.6%. And as a reminder, that is the Fed funds rate, not mortgage rates. FOMC votes unanimously to leave the benchmark rate unchanged in a target range of 5.25 to 5.5, a 2-decade high. Median forecast for PCE inflation, the Fed's preferred gauge, is unchanged at 2.4 for 2024, while core PCE projection rises 0.2 percentage point to 2.6. So basically, they're just saying they're going to give up on hitting 2%. Officials also lifted forecasts for where they see rates settling over the long term, boosting their median estimate to 2.6 from 2.5. Fed maintains a pace of quantitative tightening with a maximum of $60 billion of treasuries and $35 billion of MBSs rolling off their balance sheet each month. Central bank does not give any immediate hint at a change in the program. With so much apparently at stake heading into today's Fed events, the reality ended up being somewhat underwhelming. At least it was underwhelming in a good way for the bond markets and rates. The key revelation was a dot plot, which is the individual projections from the Fed members on the Fed funds rate, that showed the exact same median rate at the end of 2024 as seen in the last dot plot. Bonds cheered the news at first, but then got defensive ahead of Powell's press conference. Powell navigated questions without prompting any more panic, essentially convincing investors that the Fed was approaching incoming data with a certain level of optimism regarding inflation returning to the late 2023 trend as opposed to the early 2024 trend. Bonds ended up basically threading the needle with modest gains by the end of the day, ending up 19 basis points on the day at 100.75. The 10-year closed at 4.277, so breaking below that 4.3 threshold. So at 100.75, let's see where that puts us on this. So that's putting us right below that 50-day moving average, but above the 25-day moving average. So it's a really tight range there. Hopefully we can get some good attitudes tomorrow that'll break us above that 50-day moving average and start sending us up towards that next Fibonacci line.